Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. You know, inflation is becoming more and more of an issue. They're trying to downplay it, but Bob's come up with some very interesting data. It's going to be very eye-opening, and you're going to want to see where this is going. It's not good. Let's dive in and check it out.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes. And if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. We're running our February specials. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. Hey Bob, so the inflation data, I know you were talking about how it looks a lot like the 70s, and I've seen charts myself that correlates to that. But a lot of people haven't traded around in the 70s, may not have even been born then, that watch this. And of course, some of you have been around since then. But to get everybody on the same page, what are we looking at here?
Yeah, before we throw the charts up here, is that I think the expectation was that they licked inflation and that we're now going to kind of go into a soft landing and the Fed could pause and then pivot and take care of a mild recession. And we weaved our way through the pandemic response, surplus. But that's not happening. And what's happening is that we had a lot of gimmicks, so energy prices went down because they basically drained the SPR. The natural gas prices went down because they closed off an LNG port, which was a significant port, and we were pumping natural gas per the government request to help Europe during their winter of discontent. But then we had nowhere to go with the natural gas, and so it just drove the price of natural gas down. And same with food. And then China has been holding off on their growth in terms of reopening, and that's changing. So we set ourselves up really for what's called the double peak in inflation. So, and I want to show some charts here just to show that I'm not the only one thinking this. And, Phil and I have been pretty, I think, attuned to this because we trade every day in the markets. We could see the games and the gimmicks they play to try to, keep prices down in the short term. And we have a situation here where this chart here is really a long-term chart, really inflation expectations. And you see that the expectations are not going down, Phil. In fact, they're expecting double-digit inflation going into 23, 24. And I agree with that. And I mean, that's going to be an absolute nightmare. And that's the reason why Powell keeps talking. Basically, we're talking out of one side of our mouth. The administration is trying to, limit the fallout with it, and they're trying to create a narrative at the same time. And it's really not going to work because big money is already expecting a pop. Because they can see that the wage growth is not settling down. And then you can also see what's happening in China, which is our next chart. So basically here with China, they're reopening, Phil. And I'm going to show some charts at the end here to show you that steel's going up, copper's going up, platinum's going up, oil's going up, natural gas is going up, coal is going up. And really, my expectation is that you're going to see basically all that's going to wash onto our shore. The Chinese are going to export this inflation into our economy, and there's nothing we can do about it. And we're just going to have to absorb it until people just can't afford to buy it. And then we basically go from an inflationary impulse to, a market and an economic, collapse.
Right.
Now, I'll show one more chart, then I'll open it up for you to get your thoughts on this, is that the traders are already expecting it to the five-year inflation swap surge, meaning that they're expecting inflation to be endemic, okay? So they're ready for more inflation, and they're preparing for it. And this is the reason why, I've been saying, okay, the market is not going to like high inflation, and it's going to crash from it. You just have to look at history. We showed you all the charts in the past. But if you're going to be long, you better be long energy, food, and commodities because they're going to skyrocket. What people think of the market is they think of Apple and Nvidia and Meta and those guys. Those guys are going to get hammered. It's really the commodity stocks that are really going to go. So you need to start rethinking your position here because it's going to pop before we get a big drop in everything. And with that, Phil, I'm going to throw it over to you. and get your thoughts on this before we show some chart.
Yeah, I think inflation is going to, I think there's a couple things that go on with inflation. One is people say, well, if we got hot, if inflation is hot, then they think, well, asset prices rise and the market should go up. But the problem is that everyone's input costs are going up. You get to a point where you kind of choke off the consumer. There's always an equilibrium and a supply and demand equilibrium that goes on. And so we're basically coming to a head on that. There gets to be a point where things just aren't too expensive. Wages aren't keeping up, and then you get that collapse. On top of that, it's not like we have inflation and the Fed's also accommodating this market with quantitative easing, right? They're pulling liquidity away from the market. So I don't see how this continues. We're just getting these. The market action lately reminds me of March 2020, and toward the end of '08. Which I was actively watching those markets, and same thing that we're seeing now. Big drops, big squeezes. I think this squeeze now is at 3% off the lows in day and a half, essentially, of market activity, and that's exactly the stuff that you see when things are drying up in the market. So, but it's hard for people because they go, oh, gee, the market's up 150 S&P points today. Everything should be good. But if you zoom out, and even if you look at when the market topped out in 2000 or 2001. It was very much like that, where it was that kind of just topped off and then fell away. There wasn't we got a wave higher much later, but the way that it kind of fell away, it was very violent. It was down and up and down and up and down. But if you zoomed out on the daily, it was tricky because every time that up came, it was a higher or a lower high, and that's what we're seeing in this part of this leg as we roll over from 4,200. So, but it gets everybody all riled up and to rush in and buy, and it's hurting people because there's no trend to the upside that they're used to here. It's just you're either getting chopped to death, so you're either get a couple wins, get a couple losses, get a couple wins, get a couple. You're not going anywhere. You're probably losing on net, or you're just getting creamed in stuff that you're sitting in. So, but that's typically what we see in a market that's falling apart, and I think that's why the inflation isn't a good thing for this market. If the Fed's accommodating, that's in a different inflation story. That would be something like yield curve control, which is what Japan's doing, right? And when they start doing that, then you're going to get commodity increases, especially in energy, and then to a lesser extent in gold, and then probably to a greater extent in Bitcoin because it's more scarce. And I think you and I both agree that that's coming. It's just a matter of when, and the matter of when is probably triggered when we get a major event that makes our bond market completely unstable.
Yeah, and Phil, and you can see it even today, Bitcoin went down again. So, Bitcoin is really the canary in the coal mine for liquidity. So if we could, let's show some charts, because I want to show people what's been moving.
Okay.
And this is kind of where you want to be positioned. Okay, so I'm showing you a weekly chart of the steel ETF. This is all China's going to open a thing. Oh no, China's not going to open a thing. China's going to open a thing. Oh, China's not going to open a thing. China's opening. The whole time it's making higher lows here, guys, on a weekly chart. You're seeing momentum here kind of kick up, and we're breaking out of a weekly range, which is just huge. And so this is the Chinese, and we're breaking out of a monthly range. There's no such thing as a triple top, if you will. This is a W bottom, and you're looking at a move here 50 to 70, 70 to 90, 25% move up higher. Now that's great. Oh, Bob, we can make money at SLX, all the steel stocks. Yep, and yep. But if you have to buy steel, like Phil was referring to before, your input costs are going to go through the roof. And I've been in the middle of a remodel for the last 3 years. I've been just doing a room at a time, since this pandemic started, and I'm just watching prices, and literally in 18 months, prices have doubled for me in terms of the material cost and just the wage inflation. So I think this is just the tip of the iceberg. When China starts sucking the world out of materials again, you're going to see these things explode. So that's one right there. Steel ETF, just get ready for it. Okay. Now, next one I want to show you is oil, because they've been desperately trying to keep oil down. And this is what I call a consolidation on high. So we made a move all the way. Forget this thing. This was a futures generated nightmare. You should never go negative on a contract. But if you take it from here, $20 to basically 130. Okay, we've only come down in the first 1/3, which is highly bullish retracement. And we're starting to get momentum signals for higher again. This is a monthly chart on oil, and on a daily chart of oil, look at this, Phil. It looks like a table saw.
Yeah.
Is that they've been consolidating, and once it breaks this 82 area here, we're going to $115.
Yep.
And we're rolling into the high season now for energy between now and June. So Phil, this next chart I want to show you is natural gas. This is how much they drove this thing down from $7 down to $2 on natural gas. And some of it was seasonal, some of it was a mild winter in Europe, some of it was manipulation with them closing off a ability to sell the natural gas into the LNG marketplace. But that is ending here now. And now we're pushing up higher on natural gas, and you're starting to see some of these natural gas companies start to take off. And we've been trading, Devon Energy and UNG and EQT and one more out there, PDS, Precision Drilling. And they've all been flying this week. This is, I think, a more secular move. So we should be pushing up into June on this because they have to refill all storage now for the summer. And now we're getting a cool spring. So it's going to be competition for that. And then the last one I want to show you is I'm going to show you as a chart because this is basically a US-based platinum Shabani Stillwater. This also has been flushed and we're coming into the channel again. And we've had a nice trade on this thing. We got into it yesterday at 8.15, 8.46 here. And, we're looking for this to push up to $9. And these are double-digit moves higher. And remember, Russia and South Africa control platinum. And Russia and South Africa are not friendly to the United States. China's opening. China's going to suck all the platinum and palladium out of those two countries. And we're going to get the leftovers. And so you're going to see platinum and palladium stocks also rise. And all this means is that everything that everybody needs in order to live, that base rate's going higher. And at the same time, the Fed is raising interest rates and choking off the consumer, right? Costco, Target, and not Amazon, but Walmart all reported slackening sales, especially in the non-necessity areas. So we're having higher input costs, lower sales, that's higher prices. It's basically the inflationary depression mantra that we've been sharing with you guys. This is what it looks like. You'll see top to bottom move in the stock market greater than 50%. But you're going to see moves in these commodities to 200 to 400%. Oh, and also uranium too has gone up too. So we're in uranium. This is a daily here. It's on the hourly. It broke its range. Okay, this is very important to us, and it looks like it's going to then start to push higher back towards the highs of $32. Again, uranium is not economically sensitive. They built the nuke plant. They got to buy the uranium, regardless of the price. And prices have been, as you can see, have been just creeping up, and we see this continuing for the foreseeable future. So we can be short the market, we can be doomers, but we're certainly making money in the areas that are moving up higher, and we want to share that with you. Phil, any last thoughts?
Nope. I think I think you said it, inflationary depression. And it's not something that's been seen a lot in the history of the financial markets. So it's going to be, I think it's going to be kind of confusing for a lot of the average person out there.
It's been 50 years. So, and ironically, it's been 50 years since we got this kind of snowfall and rain in California. So there's something turning in the world. So be careful.
All right, guys. Well, thanks for watching. Please hit like and subscribe, smash that notification bell and set it notify for all if you could. And also check out our specials on the website at tradegenius.co. And hopefully we can see you in the room. All right, guys. We'll see you on the next video. Thanks for watching. Take care.
Trade Genius.